Welcome to this Edison interview with Acorn Income Fund. It's the 6th of May. My name's Sarah Godfrey. I'm a director in the investment companies team at Edison. And with me today, I have from Unicorn Asset Management, Fraser, Mackersie and Simon Moon, who manage the Acorn Income Fund smaller companies portfolio. And I have Chun Lee from Premier Miton, who is one of the managers on Acorn's income portfolio. Now, Acorn is unusual in that it has these two portfolios. The small cap portfolio is around 3/4 of the assets on a regular basis, and the income portfolio helps to limit volatility and add a little extra income. So first of all, Fraser, how's the pandemic changed how you work?
Yes, it has. I mean, we're lucky that we've been set up to work remotely on virtual desktops for a couple of years now, and that's all worked very well. So we're all at home, but with the access to everything that we would have in the office. So that's been great. Clearly, we're a team, so we need to remain in regular contact, and that's something we've been able to do as well. A, with each other, and kind of B, with investors and C, with investee companies. So we've been able to maintain the kind of contact with each other, with investors, with investee companies, and maintain access to all the systems and programs that we need. So in a very unusual environment, it's actually worked relatively well so far.
Yeah, it's probably worth adding that Fraser and I obviously are a team and run this portfolio together. We're obviously in daily contact. We have several calls a day. Usually, I think the average is probably about 4 calls a day. And we also have permanent IB chat, instant Bloomberg chats, WhatsApp chats going on permanently as well.
All right, and Chun, you and Robin Willis, who also manages the income portfolio, you have different responsibilities from each other. So is it different for you than it is for Simon and Fraser? And how much interaction is there between the two teams?
Well, reference to Robin and myself, I mean, we focus on different areas of the market. I look at bonds and Robin looks at investment companies. But, we work together across numerous multi-asset mandates, including Acorn. And so we have constant conversations about what we are seeing in our respective spaces. And as Fraser said, we're lucky to live in an age where technology really minimizes the impact of working at home, but also allows us to monitor the entertaining evolution of our colleagues' appearances, I guess. But regards to the Unicorn guys, we've been having regular communication with Simon and Fraser alongside our Chief Investment Officer Neil Birrell and also the Acorn board, and during this period, and we've been jointly evaluating areas such as risk and opportunities within our portfolios, asset allocation, and even exploring hedging options together.
And has anyone given themselves a lockdown haircut?
Yeah, I have. My wife very kindly went at me with the clippers. I think it was irritating her more than it was me. And I think I was due to have a haircut, I think the day after the lockdown was announced. So I was looking a bit caveman-esque.
Yeah, I've not done that yet, but you should have seen Simon the day after he got his haircut. It's grown in a bit now. It looks okay, but God.
It was severe.
So just coming back to the portfolio then, Fraser, on the small cap side, you've always had a preference for companies with strong balance sheets. How important is that right now?
Yeah, I think it's as important as ever, and it gives us confidence going into a period like this when some businesses are suffering fairly significant short-term disruption. You want to be sure that they have the liquidity to enable to survive and also thrive on the other side. And I think the importance of balance sheet strength is very, very strong at the moment. And this is something that we went into this period in a strong position. We've made a couple of changes just to further strengthen that position, and that gives us confidence at the moment, even though we're enduring a fairly tough time in terms of how small caps have underperformed in the short term. It gives us confidence in the long-term outlook.
Yeah, it's probably worth again emphasising that point on the importance of well-financed companies, and I think the the balance sheet strength across the portfolio, as Fraser says, was very strong going into it, and always has been. It's a method. It's something that's key to our method. But the net debt to EBITDA is very low compared to that of the market as well.
All right, thanks. Well, obviously, balance sheet strength is key in financing dividends, and there's a lot of dividend cuts in the headlines at the moment as companies seek to conserve that cash, and in some cases, for regulatory or perhaps political reasons. What impact is this having on on Acorn's portfolios, and do you anticipate it will have an effect on the Trust's own dividends in the coming financial year? Should we start with you, Chun?
Yeah, sure. Well, I guess the bond market certainly seems to be an area where investors are focusing more on as I guess a more visible source of income, given the higher certainty of coupon payments as companies prioritise debt repayments. In addition, as you alluded to, we're seeing some large institutions such as banks deferring dividend payments due to regulatory pressure to shore up their capital. And this is another area where I guess the benefits are effectively transferred from equity to bondholders. Meanwhile, central banks across the world have greatly increased their intervention in bond markets, and this has helped reopen funding markets to companies who've been able to issue new bonds to ensure they have the funds to service existing debt while revenues are impacted. Of course, besides bonds, we also hold some investment companies, which we believe offer attractive yields and diversification benefits. And I guess here we expect to see some distributions cut, given the more uncertain times. However, we do have other holdings which are exposed to less disrupted areas, I guess, such as supermarket leases and music streaming royalties, which should be a beneficiary from this environment. And these we expect to continue paying as planned. So overall, I guess we don't really expect a great change to our generated income.
Thanks. Simon, so what are you seeing from companies reporting at the moment?
You're seeing companies, you're seeing certainly a less certain dividend outlook. You're seeing companies either pause or cancel dividends for a variety of reasons, primarily focused on whether it wouldn't really be politically expeditious to pay one if they're taking government support, or through liquidity concerns. What we've done on the portfolio is split it into three main categories. That would be continuity. Those companies we expect to continue trading as normal or as near to normal as possible. Resilience, those companies that might have some impact from the virus and the lockdown, but that are able to, with certain measures in effect, carry on trading reasonably well and set well to recover when the lockdown eases. And recovery companies that are currently very unlikely to pay a dividend, but ones that can resume so quickly when the lockdown eases.
Thanks. And Fraser, what sort of impact do you think this will have on Acorn's own dividends?
I mean, at this early stage in the year, on the small cap portfolio, we're modelling a number of different scenarios based on the groups that Simon has just been through. So continuity should continue to pay as normal. Resilience, we think, will still receive dividend payments, but they'll be of a lower level. And in recovery, it really depends on when the lockdown starts to lift and when companies feel confident again to start paying dividends. So the outcome for the full year is quite a broad range at the moment, and really depends on when the restrictions are lifted. But clearly, with people expecting dividends to be cut by up to 50% in the UK this year, our outlook is not as robust as Chun's in terms of the income generated this year.
Okay, and at the trust level, I think you reported last week the second interim dividends payment, which was, I think, level with the first, up on the prior year, and I think the board noted that that the trust has quite strong reserves, and that therefore they're sort of cautiously optimistic, I think, for the full year. Would you say that's a fair summation?
That's correct. Yes. Yeah. I mean, it was all fairly clear in the statement last week. The thinking's there. We are fortunate to have that reserve there, which was coming to good use in this quarter.
Great. Okay. So staying with the small caps there for a moment. There's obviously been, as there often is in severe market dislocations, a bit of a flight, if not to quality, then certainly to size. Do you think that small and mid-cap companies have been unfairly punished by the market, or does the magnitude of the sell-off reflect the benefits of scale in challenging times?
Yeah, I mean, I think the sell-off in small and mid-caps is probably a fairer representation of the challenges facing UK corporates than you've seen in the large caps. So small caps have underperformed large caps so far year to date, which is typical of what you'd see in a sell-off. We've been surprised with the relatively strong performance in some areas of the market that we don't invest in, given the very uncertain outlook. So I guess small caps have performed as you would expect in a period like this by underperforming large, as we've seen in numerous different sell-offs. But I think they probably are also slightly more accurate in terms of the expected impact that companies will see in the coming months.
Yeah, it's probably worth emphasising as well, after we do see a more severe sell, generally in small volatility, you tend to see a harder recovery, a faster recovery as well.
All right, thanks. Now, Chun, in the introduction, I mentioned that the income portfolio, part of its raison d'etre, if you like, is to limit some of that volatility that you can get in small cap companies. Has the portfolio shown those sort of defensive characteristics during the recent market sell-off, or was the scale of the dislocation such that perhaps a falling tide saw all the boats going out into the harbour?
Yeah, well, you're right. We've been trying to manage the income portfolio with a sort of more absolute return mindset in recent times, and I guess we were reasonably pleased with how the income how it reacted at the height of the market panic, where it felt as though there was literally no asset class to hide in. There was a period when we saw equities, corporate bonds, government bonds, and commodities as well all suffer a synchronized fall. And of course, we weren't going to be immune to that, but our shorter duration credits exposure and our additional hedging strategies did help us reduce the level of drawdown at the time. I also think not being a forced seller was also an important trait, because liquidity, across many markets simply vanished, and sellers had to take prices at substantial discounts to what were already weak sort of quoted broker levels. And of course, this disorderly selling in markets did affect our less liquid bonds and investment companies, although overall we've seen a decent recovery since.
Great, thank you. So Simon and Fraser, you mentioned that you're looking at the portfolio at the moment in terms of three different types of companies, and one of those was recovery. Which areas of the portfolio would benefit most in a stock market and an economic recovery, whatever the shape of that recovery? Is it those recovery stocks that are likely to benefit most, or are you looking at them as recovery more from a dividend perspective?
Those sectors that are more likely to recover faster are, they're fairly obvious, really. We've got quite a lot of construction and building materials exposure within the portfolio. A lot of that sits within that sort of recovery basket. And when you look at the potential shape of the easing of lockdown restrictions, it's far easier to imagine, construction sites getting back to work earlier. You've already seen announcements from some of the large house builders that's occurring. These are areas in which it's easier to work with social distancing. From both a supply and demand point of view, so building materials can be produced and get to sites very quickly. So I think the recovery there would be pretty fast.
Yeah, I think we've been very clear in kind of aligning ourselves with the areas of the market that we think will have the capacity to recover quicker, which should flow through into a faster recovery in dividend payments, and also avoid the sectors where we think there'll be longer term and maybe permanent damage, which the market we don't think is pricing in certain areas.
And what sort of areas would those be?
Well, there's been a permanent shift. I think it's very, very broad. I think, consumers are going to be restricted in their activities for quite a long time in certain areas, and social distancing works well in some areas and less well in others. So I think there'll be some long-term challenges, certainly in some of the consumer-facing names.
All right, thank you. And Chun, in the income portfolio, which areas would be best placed for a recovery?
Well, I think Robin and myself are still quite cautious about the issue of visibility at the moment in terms of how long the disruption lasts and what longer term damage it causes to firms and consumers. But having said that, I guess we would expect investment companies trading on large discounts and holdings maybe sensitive to areas such as property and emerging markets, which have suffered in sentiment, to recover as the recovery gains momentum, especially if interest rates stay low. And I guess if we do end up having a faster recovery than anticipated, then there's a chance that the market's potentially underestimating inflationary pressures. And in that scenario, I guess some of our more inflation-linked investments could fare better. Clearly, at the moment, the focus for policymakers is really on avoiding deflation, and the prospect for an inflation overshoot seems somewhat remote. But we haven't had much inflationary pressure from the monetary stimulus that we've seen since the financial crisis. But I guess it remains to be seen whether the unique combination of huge monetary and fiscal stimulus that we're seeing right now might have different results.
Yeah, there still seems to be that two schools of thought going on, doesn't there, with the deflationary versus the inflationary doomsayers. It's all doom, but it's just what type of doom. I think we've had a pretty good run through here, but just to wrap up, thinking about the lockdown and the fact that we've been promised some clarity on potentially relaxing it, or whether or how that might be possible this coming weekend, do you think that things will go back to normal, as it were, once the measures are relaxed, or do you think that there are some things that you'll do differently on a more permanent basis? Fraser?
Yeah, I think it's the latter. We kind of touched on it on the previous question there. I think there will be some certainly long-lasting, if not permanent, changes to how we all conduct ourselves and how we all behave. And the challenge for us is trying to anticipate what they may be and how they will affect the portfolio. But on the flip side, there are areas that we think will get back to normal fairly quickly and have the capacity to get back to operating at near normal levels quickly if the demand is there. So, on one side it's encouraging, on the other side there are certainly longer term challenges out there for equity investors.
Yeah, Simon, I know that one of the things that you guys like to do is to go on site visits for with your holdings and potential holdings. Is that something you think, is it important to be able to sort of get down and touch and feel things, or is the virtual world the way forward?
It is important to go and see things on the ground, just for your own understanding. I think you can see representations of something, you can read descriptions of something, but actually seeing a process in action is hugely important. And whether in the short to medium term that needs to take place via a virtual tour or any other method, that's certainly better than nothing. But it will always remain an important part of our process and seeing the companies operating on the ground.
Thanks. And Chun, do you see yourselves doing things differently as a result of this?
Well, I think most businesses will be presented with options to get them working to some degree, whilst those of us fortunate enough to be able to work from home with minimal impact will only get better at it. It's been an ongoing trend for a few years, but now that the plaster has, I guess, been pulled off en masse for firms, the concept of working at home, that culture seems to strengthen, and I'm certainly supportive of that, given its environmental benefits too.
Great. Well, thank you very much, all. This has been Edison Audio, and it's been a pleasure to catch up with you all, and I hope to see you all on the other side, whatever that might be. Thanks very much.
Yeah. See you soon, sir. Thanks very much.
Thank you.